Have you ever looked at the price of something imported and just thought, wow, that feels way more expensive than it used to? Well, a huge part of that feeling comes down to the long, slow fall of the Indian Rupee against the US dollar. This is a story that's been unfolding for over 2 decades, and it involves everything from global oil markets to decisions made right here at home. So, let's unpack it. First, let's rewind the clock a bit. Go all the way back to the year 2000. Back then, one US dollar would get you about 45 Indian rupees. For a lot of us, that was just the number, you know? It was the benchmark that felt normal for a long, long time.
Okay, now snap back to today. That very same US dollar, it now gets you over 83 rupees. And that's not just a little bump. That is a massive drop in value over 20-something years.
And that brings us to this central question, doesn't it? It feels like a total paradox. India has been celebrated as one of the fastest growing major economies on the planet. So how is it that, at the same time, its currency has been getting weaker and weaker? What is really going on? Let's break it down. To really get this, we've got to start from the inside out. We need to look at the structural pressures that have been building up within India's own economy for years. So at its core, you're looking at a fundamental imbalance in our trade. Think about what India imports. We're talking high-value, absolutely essential stuff like crude oil and electronics. Then you look at what we export, and while our exports are growing, they often just haven't kept pace in terms of sheer dollar value. This creates what's called a persistent trade deficit. So what does that deficit actually mean? Well, think about it like this. Every single day, we're spending more foreign money, mostly US dollars, to pay for our imports than we're actually bringing in from our exports. This creates a constant, relentless demand for dollars, which naturally puts downward pressure on the rupee. And a massive piece of this puzzle is our energy dependence. This is huge. India imports over 80% of its crude oil. So every single time global oil prices spike, our import bill just explodes. The demand for dollars goes through the roof, and the rupee takes a hit. And you feel this directly every time you fill up your tank. It's a major, major economic vulnerability. But look, it's not just about what we buy and sell on the global market. The policy choices made right here at home, they've played a massive role in the rupee's journey too. You know, opening up the economy from the 90s onward was kind of a double-edged sword. On one hand, it brought in a flood of foreign investment, which was fantastic for growth. But on the other hand, it meant the rupee's fate was suddenly tied to the whims and moods of global investors. When they're happy, money flows in. When they get nervous, money flows right back out. And then, if you look at the period after 2014, we had this rapid-fire series of big structural reforms, things like demonetization and the rollout of GST. Now, the goal was long-term strength, but in the short term, they caused some serious economic turbulence. That, combined with some problems in the banking sector, slowed down growth for a bit and, you guessed it, made foreign investors pretty nervous. Okay, so let's zoom out for a second, because honestly, this isn't just an India story. A huge part of this whole equation is about the sheer incredible power of the US dollar itself. So there's this term you've got to know, capital flight. It's basically what happens when things get shaky around the world. Global investors get scared, and they pull their money out of countries they see as risky. They do that by selling off local stocks and bonds, and they scramble to convert that local currency back into what they see as the safest asset on Earth, US dollars. And one of the biggest triggers for this capital flight? The US Central Bank, the Federal Reserve. It's a simple chain reaction. When the Fed raises its interest rates, suddenly it becomes way more attractive and safer to just hold US dollars. So, investors sell their Indian assets, dump rupees, and buy dollars. That rush for the exit causes the rupee to fall. It's a classic domino effect. And look, this isn't some one-off thing. We've seen this movie play out again and again and again. It happened during the 2008 global financial crisis, during the taper tantrum of 2013, and of course, during the massive panic when the pandemic hit in 2020. Every time there's a major global scare, investors run to the safety of the dollar, and currencies like the rupee feel the pain. So why did things seem to get so much worse after 2014? Well, you could call it a perfect storm. It was this moment when all of our internal vulnerabilities got slammed by one global crisis after another relentlessly. First up, you had the shock of Brexit. Nobody really knew what was going to happen, and that uncertainty sent ripples across global markets. Investors started getting wary of taking risks in emerging markets like India. Then, right on its heels came the US-China trade war. This threw a wrench into global supply chains and just added this whole other layer of anxiety, pushing more investors toward the perceived safety of the dollar. And then, the big one, the COVID-19 pandemic. I mean, a once-in-a-century global shock that brought the world economy to its knees and triggered an absolutely massive flight to safety, hammering currencies everywhere. And most recently, the war in Ukraine, which unleashed a global energy crisis and an inflation crisis. For a country like India that imports so much oil, this was a direct body blow. It was just one shock after another, and each one made the dollar stronger and the rupee weaker. Okay, so after all of that, what's the big takeaway here? Let's try to pull this all together and look at the bigger picture of what a currency's value really means. Now, I gotta say, a weaker currency isn't all doom and gloom. It can actually help your exports, right? It makes them cheaper for other countries to buy. But, and this is a big but for India, when you're a nation that has to import so much essential stuff, especially fuel, the downsides, like higher inflation and a ballooning import bill, yeah, they usually hit a lot harder. So, to sum it all up, the rupee's two-decade fall isn't because of one single villain. It's the cumulative results of India's long-term structural weaknesses, our deep reliance on global capital, and a series of relentless geopolitical shocks, all happening in a world that still revolves around the US dollar. Ultimately, a currency's value is like a report card on the health of its economy. A strong currency isn't built on slogans or political claims, it emerges from real economic muscle, from innovation and technological progress, and from the deep-seated trust that the rest of the world has in your country's future. At the end of the day, a currency is so much more than just an exchange rate. It's a mirror. It reflects a nation's journey, its challenges, its ambitions, its vulnerabilities. And so the real question we're left with is, what story is the rupee going to tell about India in the decades to come?